From Washington, this is the Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, April 15th. Is it tax day? It's not quite tax day. Monday is actually tax day because today is also Good Friday. So markets are closed. And are banks actually closed, guys? Do you know? I don't know if banks
They've changed a lot of the banking rules. I think they're open now. Yeah.
It'd be like a banking holiday, but I don't think it is anymore. But nobody goes into banks anymore either. But you're listening to the Macrocast. This is Tony Fratto. Macrocast brought to you by Hamilton Place Strategies and Markets Policy Partners. And Markets Policy Partners here are John Fagan and Brendan Walsh. Guys, it's really good to see you. Crazy, not crazy. Yeah, I mean, look, it's. I had some people reach out to me because they heard Jen Psaki say something a couple days before the announcement that of CPI that that the numbers are going to be bad, or maybe she said something the day before. And people calling me like, "Did they get the numbers? They get the numbers?" And I said, no, like everybody knows the numbers. Right? Like these were not the precise bad. Although there was, we could talk about what the numbers are and see like was it all bad or not. But the anticipation that this was going to be a hot number was pretty obvious to everyone. Brendan, you have the numbers. What did they? Why don't we start there?
So if you just watched the news or read CNN or whatnot. What everyone focused on was the headline inflation rate. So that includes everything. That's gas and food. And that was up 8.5%. It was slightly higher than it was expected at 8.4%. And on a month-to-month basis, it was up 1.2%. That's the story that got told. That's not good. You can't deny that at all. The thing that was most interesting to me, what the market focused on, and what I think is the most important if you're kind of doing economic analysis, is the core inflation rate. That takes out gas and food. And that on a month-to-month basis was up 6.5%. But the real story year-to-year was up 6.5%. That's what was expected. What the very interesting one was on the month-to-month basis, it was only up 0.3%. So when you take away the volatile things like food and energy, which you can't deny, those have been affected by the war in Ukraine.
Yeah.
The goods inflation that had so accelerated over the last 2 years when we didn't go outside and spend anything on services, we just spent stuff on goods. Those prices skyrocketed. A perfect example is the cost of a used car is up 35% on a year-over-year basis. But in the month of March, it came down 3.4%. That's the first time that we've seen deflation in used cars in 2 years. And normally all we see is deflation in used cars.
Right.
So a lot of the Wall Street economists are saying that on the core side, March was probably the peak inflation for the time being, unless something new, crazy, knock on wood, happens. It's hard to predict what's going to happen, with the price of oil, because that's now a geopolitical issue. But we are seeing moderation in the components that went crazy on the good side, and we're not seeing a huge acceleration in services inflation. So from the Fed standpoint, this was probably as good of a report as you could have gotten. They still have to raise rates to normalize and to fight it still is extraordinary high inflation, but there are signs that it's not getting out of control.
Yeah, this was we saw a flicker of hope in financial markets after the CPI and in the ensuing trading that futures markets began to shave off some of the most aggressive pricing of Fed rate hikes over the coming meetings, and Governor Waller actually got on TV and said, this may well be the peak of inflation, and there's a statistical component too. If you look at the real takeoff of inflation, it was around this time last year. And you've got the base effect. This is the markets had, they were sort of a little bit of a flash forward, a little bit of a peek into the future of where inflation may be coming off the boil. And we've seen this talked about in recent weeks with, as Brendan mentioned, the used car prices coming off, freight rates coming off their extremes.
This is an underreported statistic. Freight rates have fallen off a cliff in the last
shipping. Even Asian shipping rates have come down pretty significantly, right?
Yep, and gasoline prices are still very elevated, and all of these prices are still very elevated relative to the baselines previous.
But they are actually coming off. So the April numbers will be better. Just driving around, I drove up to New York, and I was in Georgia last week. Where it used to be $4.50 everywhere. Now you can get gas easily under $4. So the headline rate next month in April, gas prices will be a negative, not positive.
Yeah, but markets relief didn't really last all that long.
No, it didn't.
Like Waller talking about the peak of inflation is not hanging up a mission accomplished banner by any stretch of the imagination. This is a Fed that is still very determined to tighten rates and tighten monetary policy, tighten financial conditions aggressively in the face of what will still be elevated inflation. And you see things like the very next day, like the PPI, the producer price index came out, that tends to flow into CPI. And that was worse than expected. That was a really eye-poppingly high number. And when we look at things like, obviously, the ongoing crisis in Ukraine, if you kind of extrapolate events, the Europeans may be forced into tighter and tighter energy embargoes, which will put, support oil prices, energy prices from here potentially. That's certainly the risk is dramatically skewed to that kind of upside scenario. And, we'll talk a little bit more about this later in the show, but China, we've seen these kind of false dawns in the supply chain, where things look like they're getting a little bit better, and then another snarl comes up, and that's front and center in the risk factors for that are China's lockdowns that we've all seen the news about for COVID. So it's they're the very peak headline CPI may be behind us, but it doesn't mean as much as it might.
The most interesting report I saw all last week, it was very out of consensus, was from BlackRock, who is the largest asset manager in the world. And they think that the Fed will only get to 2% Fed funds rate, because that's as much as the economy can handle. And then they'll chicken out and have to pause, where everyone else is 3 to 5. Some people are expecting outrageously high numbers.
If you just
I don't know necessarily that 2 is right, but I think we've always been in consensus that the market is pricing in way too hawkish. And if you just look at history, the Fed never gets as far as the market initially expects them to.
But no one's taking a 50 basis point hike off the table, right?
No, I think that's pretty much consensus, and it's priced into the market now.
Yeah, they've almost written it in stone at this point.
And at this point, for the Fed, it'd be silly not to do it.
Yeah, they know where they're going, and getting there a little bit quicker is probably a good. They've signaled it to John's, both of your points. Like, they've signaled it so hard, like they'd have to hit it, and it's not like they're not going to get there anyway. So just get there and just do it. Show that you can do it, and then see what the impact is and look ahead. Do you think the pop in mortgage rates?
I was just going to say this.
Yeah, it looks like it's gotten, like, they've risen. Mortgage rates have raced ahead for faster, I think, than people thought, right?
Yeah. So, you used to be pretty much, this is going to be an amazing dynamic, because it's never really happened quite like this before, where because of the pandemic, we had this massive housing boom where a huge amount of people bought houses that have also since appreciated. But also, you were locked in your house, and rates, you could refi into a 30-year mortgage at 2.5% or so. A 30-year mortgage is 5% now. So we might see a massive slowdown in the housing market, simply because people won't move, because they don't want to give up their 2.5% 30-year mortgage,
Yeah. I could totally see that. I mean, why, it's such a huge, I mean, such an amazing price, right?
And we have the data from the Mortgage Bankers Association. Pretty much everybody refinanced into a 30. So like,
we did.
Everyone.
We actually had a relatively small mortgage left on our house in Pennsylvania, but it was stupid not to refinance.
Why not? Yeah.
So,
well, right now you can buy a 10-year treasury that yields more than your 30-year mortgage, theoretically.
It's a good arbitrage.
Yeah.
Yeah. Free mortgage.
Yeah. But now the consequences of that, right, are, so for buying fewer houses, if you are at Lowe's or Home Depot, you sell rugs and windows, roofing, all of those things. So that's the market that should cool off, probably first, right?
I think so. And we have Redfin, they showed data that buyers have had to, or sellers have had to start cutting their asking prices. So it hasn't flowed into prices dropping officially yet, but the asking price have had to start come down in the last few weeks.
And this will be interesting when we get around to Home Depot, Lowe's. We're in earnings season now, and we'll talk a little bit more about that. But this is going to be something that their management is very keyed in on, and we'll get some good granular data points from them when they do report. That tends to be much later in the earnings season.
Yeah, definitely. But we had we saw retail sales.
Yep.
For March also. How much of that is pricing rather than quantities?
Yeah, that's a good point, because we don't adjust that for inflation. So if the price of gas went up 10%, we still tend to buy the same amount of gas on that first month. We just pay more for it. But what you did see, we basically spent the same amount of money, but you did see a shift in where we spent it. You had to spend more on gas, and you spent some less on going out to dinner and things like that. So the consumer still has enough money to spend at the current rate. They're just adjusting where they are spending that money.
Yeah, and if you think about what we've seen, you mentioned earlier what we saw in terms of shipping down, transportation down. That means like fewer goods are moving, but the goods that are moving, you're charging a higher price for. That's a reflection, I think, of a demand slowdown.
I think you're right.
Right. Yeah. Or shift to services, but either way, but that's what. And
I think it's a combination of those two. We bought so much goods, we don't really need any more goods, and now we want to go out and have fun and do things. So we're spending more. We're shifting our expenditures. But also, the global economy is slowing down, especially because of the war, and that's showing up in the cost of shipping products.
Yeah, definitely.
Yeah, plus we're looking through, parsing through some of the CPI data and looking for increasing levels of price sensitivity by consumers, and so there was a sense that maybe a buyer's strike in used cars was contributing to some of the price declines, and that certainly seems to be the case in the data. There was also there was at least some sort of stabilization in food prices, basically restaurant food prices.
Yep.
And it's that, restaurants have maybe reached the outer limit of their pricing power. They've raised prices to try to account for the increased costs of inputs and so forth, but they're beginning to see, this is obviously, you don't want to make too much out of one data point, but it is the kind of thing that would manifest itself if consumers are saying, hey, I used to go out to eat. I have to cut back on going out to eat because it hits me so hard in the wallet. This is the way. The cure for high prices very often is high prices. And the question is, down the road, does this feed into a cyclical growth decline? And you have guys like St. Louis Fed President Bullard who says the quiet part out loud, and he says, "Hey, look, it's fantasy land to say that the Fed is going to achieve its inflation goals without taking a hit on the economic growth side, and so that's certainly, he's obviously on the hawkish side of the committee, and the rest of most of the rest of the FOMC puts it in a more delicate terminology. But watching Fed Chair Powell dance around that fact doesn't change the fact that is where the Fed appears to be.
Well, right. Look, I mean, if you are trying to bring inflation down, which is their mandate,
Mm-hmm.
you could there's the thing that you have to do. That's what the policy rate does, is try to manage demand. That's what it does. So. Right. I mean, you're going to raise rates.
Very blunt tool.
You're literally. So when he says that, it's a kind of like axiomatic. Well, obvious. That's what happens. You raise the price of doing stuff, so people will do less of it, and so therefore price pressures should diminish. And so the trick is, if you say you're going to shave off 2% of GDP growth in order to bring growth, in order to bring down inflation. The question is, where are you starting? So, right, yeah. Where is growth right now that you're shaving off a point and a half of GDP that you're not pushing the economy into? And look, for Q1 GDP right now, estimates for Q1 GDP are pretty low, right? I mean, I think they're in the 1 to 1.5%
exactly, yeah,
right, 1% range maybe right now. I think I saw the Atlanta Fed's GDP Now cast is like somewhere right around there. Private sector blue chip forecasts are a little bit above that, but not much. So how much are you taking off if you do that? And that's where the recession fears come into play. But I mean, look. Landing a big airplane is dangerous. It's true that you're off by a little bit. You could have catastrophe. Let's hope we don't have catastrophe. Let's see if we can touch down with all the fuel, the wheels on the ground, and keeping the airplane analogy. It's been a bumpy ride, So let's see if we could just just let them land it. I think they're trying to do it the right way. I think if they moved much faster than what they're doing right now, I do think you are very much risking a hard landing, given what's happening with everything else. I just think it's a little bit of moderation is probably the right way to go. Hey, why don't we take a break and just talk about a couple overseas items? Let's talk a little bit about China and Europe very quickly. We'll come back and get into those things on the Macrocast.
Hamilton Place Strategies, HPS, is an analytical public affairs consulting firm with offices in Washington, D.C., New York, and California. HPS uses substantive analysis to understand complex topics and create public affairs tools to explain issues to target audiences and reach critical stakeholders. We achieve our clients' goals by enhancing understanding of issues, products, and companies, and ultimately improving outcomes. Learn more at hamiltonplacestrategies.com. or follow us on Twitter at HPS Insight.
All right, back on the Macrocast. Guys, we have IMF World Bank meetings next week in Washington, and they're as they do before their spring meetings and fall meetings, revising their forecast. They've knocked down global growth a little bit, and as everyone has, which is by the way, it's sort of a demand slowdown globally also doesn't helps with should help forward-looking inflation expectations as well. But ECB, they kept rates the same, they unchanged, and then but how did you read their outlook on that, guys?
Well, the ECB has been pretty the ECB has been pretty dovish relative to other global central banks. It has, although obviously the ECB speaks with many voices, given the traditional split between Northern and Southern European monetary philosophies. But President Lagarde is a very steady hand on the tiller, and she has sprung some modest surprises, I think, over the past couple of meetings, being perhaps a little bit more hawkish at the prior meeting, where they were more aggressive in basically winding up asset purchases than market participants had expected. But disentangling that process of peeling back asset purchases from rate hikes, and keeping rate hikes still an amorphous kind of time schedule, no hard and fast commitments to that, and so the markets have been trying to price where the first rate hike is going to land. Are they going to hike 25 basis points? They have hiked 10 basis points in the past. Something of a moving target, but they don't seem to be in particularly big hurry for liftoff the way that for interest rate liftoff the way that the Fed has been. Yeah. And part of this is the European Central Bank. They're not using the discredited transitory language, but they still use that kind of formulation, that kind of framework to talk about inflation, talking about it as a supply shock and as a drag on growth. And they've got a very challenging growth outlook. Germany is in potentially a technical recession, potentially a more than technical recession. Here, the Bundesbank has warned on the growth outlook. The Europeans have to prepare for the possibility that the Russians do something so outrageous in Ukraine that they, their hand is forced in effect and have to cut off the vast majority of Russian energy supplies, which I think by any economic metric would force Germany and a lot of the region into an immediate recession. Mm-hmm. This is a really challenging spot for the ECB. They're picking their way carefully and having that balanced kind of dynamic between inflation control and growth risks. We think that the euro is basically bouncing around multi-year lows. It doesn't look like it's got particularly great support from our viewpoint. And the Federal Reserve is, we think, eventually gets back to a more balanced formulation where they're putting, they're highlighting downside risks to growth and, not as great risks on the inflationary side. But we're months away from that. We're probably that's at the earliest, probably the very earliest, like the July meeting, September meeting kind of time frame. And the ECB is, going to be holding that. They're already in that balanced monetary mode. So the divergences are huge. And when you look at the Bank of Japan, that is, that's a very staunchly dovish central bank. The People's Bank of China is about to eat. We'll talk a little bit more about why, but they're going to be going further into easing mode next week. And then you've got, Bank of Canada and the Fed here getting 50 basis point clips under their belt for rate hikes. So it's a very wide divergence.
A couple things on that, John. One is, I do want to jump right into China after this, but just with this sort of divergence, with we talked about the Fed, clearly on a rate hiking cycle. The rest of the world either not there yet, except for the Bank of England, but the rest of the world not really there. And some going in the opposite direction for different reasons. This should be like pretty bullish for the dollar, right? I mean, we should probably see dollar strength, right?
Yeah, absolutely. But the dollar strength this year, as it hasn't been a moonshot. That is a good thing. You don't want the dollar to be rampaging across the globe. It has been relatively restrained. One of the things that we're seeing is that within major currencies, just like there's a divergence of monetary policy, there's a corresponding divergence of FX performance. And so you see the commodity countries and countries with more aggressive central banks, and they're outperforming against the dollar. The Canadian dollar has been relatively strong. You look at, the Australian dollar has a big rally based on its, commodity, the baseline of commodity exports that economy depends upon. But then you look over at like Japan, the yen has been a punching bag this year, and that really tracks. And that's a healthy, sensible kind of divergence that makes a lot of sense. One of the things that if you play that game across the spectrum of currencies, however, one of these things does not look like the others, and that's the renminbi. The renminbi, the Chinese growth, the recent purchasing managers indexes came back looking awful. They were all in, they were all in contractionary territory, right? And so when you see contraction, when you see Chinese data that looks bad, you always, mentally, because it gets a little stage managed sometimes.
Yeah. You have to assume it's A, it really is bad, and two, it's probably worse.
Yeah, that's exactly right. So if they publish a contractionary PMI, you say, oh, well, where was the real number? And the People's Bank of China is in easing mode, and the renminbi has stayed pretty rock solid. And that's kind of it's a fascinating dynamic to follow through. But yeah, China is in a really, really it's in a really difficult place right now from the outside looking in, and that's really the best we can do. It's hard to really know what's going on the ground, but
just from what we see from the outside looking in, I mean, I think it's pretty safe to say they have pretty absurdly mismanaged their trajectory on COVID. The zero COVID policy has been really damaging for them, and Xi is not backing down. He's doubling down on it, that it's the right policy, and they're going to stick with it. And so,
and a lot of it has to do with they have a crappy vaccine, and they refuse to use ours because that would be embarrassing.
Yeah, it's but even their crappy vaccine, if they would actually have given it to old people, they have, I think 40% of elderly Chinese are not vaccinated, which is just mind-boggling. The rest of the world, the United States and Western Europe and everywhere, understood that old people are most vulnerable and should get the vaccines first. We actually distributed them and continue to here in the United States, where old people get them first, being the most vulnerable. It's mind-boggling that they have the opposite in China.
It's absurd. Like, what's the one benefit of being a totalitarian, authoritative state is you can make people do what you tell them to do. And
you do the right. They
didn't do it.
And instead, they've chosen food riot to engineer food riots instead.
I mean, the decision making is so. It seems on its face so bad that people are groping around for alternate explanations, thinking it immediately calls to mind, this search for what's the real reason they're doing this. They can't possibly think that COVID zero and locking down Shanghai, and Guangzhou is about to get locked down too. Almost certainly that's been incredibly just mishandled. It's what it seems clear that it's been mishandled and mismanaged and just malfeasance. But it has sparked speculation that this is being done on purpose. President Xi's power base, the power base of his rivals are all in Shanghai. It's a very this sort of soup of murky political speculation. This is a huge year for China politically. This is where President Xi is going to be going for his historic third term at the Party Congress in the fall. And, this was a time when, no mistakes, no hiccups, smooth sailing. That's what everybody thought would be, the path into this is usually the way it goes. Everything, they stimulate the economy. And so it's all like roses and, champagne and smooth sailing when they actually go into the Party Congress. Certainly, maybe they're trying to get that out of the way early this year and stabilize things a few months before. But it's a really weird situation. It's going to have reverberations in the supply chain. The port of Shanghai is apparently a total disaster at this point. And where we've seen this again and again. Every time we feel like supply chains are on the mend, something else seems to undercut them.
Yeah, it's just truly really unfortunate. I mean, China, there are a lot of people here in the United States who say, well, why do we care about China? It's like China's economy as a growth engine and as allowing our economy and other economies to function properly, needs to have done a better job. And so that they're hurting growth everywhere by their really amazing, blindingly bad failures right now. And so we'll be keeping an eye on that too. Hey, why don't we come back and we have to talk about the fun story of the week, right? I mean, we can't be the only podcast that is not talking about Elon Musk, right? So let's come back after the break and get into Musk and Twitter.
Check out HPS Insights, a regular podcast from Hamilton Place Strategies, bringing you the latest on policy debates affecting the business and political communities. Available on the HPS podcast channel on your favorite streaming platforms, including Apple, Spotify, and Google. Tune in to the latest episodes and learn more at hamiltonplacestrategies.com/podcast.
All right, back on the Macrocast. Guys, I don't even, let's be clear. There is no macro story to Elon Musk buying Twitter. So we're just wedging it in here because we're on Twitter. We pay attention. Go ahead. I want to hear it. You've got it, Tom? Yeah, let's hear it.
I got the macro case.
All right.
This is it's follow the thread. And it's pretty thin. But basically, the speculation is Elon Musk buys Twitter, immediately lets President Trump back on, and then that completely changes the political dynamic going into not only the midterms, but into 2024. And that is a relatively longer term macro story. But that's the macro case for this being a something consequential for broader markets, not just Twitter stock.
That would have a consequence for me. I look clearly. I mean, if I don't care if Elon Musk buys Twitter, and I don't care who owns Twitter, right? I mean, whatever. Like buy Twitter, buy whatever you want, and but if you put Trump back on Twitter, I'm off Twitter. I won't leave Twitter if Elon Musk buys Twitter. But if he puts Trump back on Twitter, I don't know what the line is, but spurring insurrections is that's where I draw the line. And I'm not going to mix with guys who spur insurrections of the United States of America. So that'll be my line, but we'll see what happens with it. I don't think it's going to happen, though. Personally, I think actually he's got much more regulatory jeopardy than I think people are really paying attention to. There was this sort of view that you do a 13G violation. You're supposed to file a 13D, which is passive. Should have filed a 13G because it was obviously active and intended to be active. That's clear. And was even having conversations with Twitter management while he was filing the 13D. So clearly it was active. And there seems to be a view out there that the SEC is toothless and can only slap a $100,000 fine on it. And I think that is absolutely wrong. There is a lot of discretion, I think, that the SEC has, and maybe even working with DOJ on this. This was you can amend your filing on a 13G because you made an inadvertent mistake, good faith errors, and you can amend it and maybe you get fined. But that's not the case here. I mean, it was clearly his intention to be an active owner, and those reporting requirements this is what they're designed for, so that public investors are not surprised by big movements in the stock. This is the whole point of it. So we'll see. I don't think it's going to happen in the end.
I mean, he doesn't even have the funding lined up. So this wasn't a serious effort, but it's kind of fun.
Yeah, he says he can get the financing. And I've seen people make really strong arguments that he can get the financing. And I just think, he has also said, I really don't care about making money on this. So who puts up financing when the guy says,
right, yeah,
I'm not interested in this being a going concern, but please finance it for me. I connect those dots for me. I don't get it.
Yeah.
That said, the guy he's a product genius. he, I was actually fine with, if he was going to go on Twitter's board and they were going to have access to his ideas, 8 of which would be absurd, 1 would be unworkable, and 1 might be really, really good that could make a big difference for Twitter's long-term growth. I think that would have been perfectly fine to have him on the board, but not running the place. We don't want Musk running Twitter.
Yeah, it seems like there's, the board has plenty of the regulatory stuff, and there was a reference to a background check that that the Twitter that they referenced in their press release on this topic. Who knows? There's clearly the possibility that this is Elon Musk trying to make a point. He can make a point in a very splashy way, the way in which he's certainly well aware that his words carry a lot of weight to move stock markets around, and I'm sure that he although he says he doesn't want to make money on it, he may be trading around these particular dynamics that he's creating. He's known to do that sort of thing, and making the SEC look powerless is one of the things that he appears to enjoy doing. And so this is it's very on brand, but the board doesn't have to let him do that. They have they obviously will have plenty of justification to say, we're not gonna take this offer seriously. And and by the way, we're going to institute a poison pill defense, which they aren't that popular now. But I don't know if you come down differently on this, Tony. But poison pill defenses, if you put them in place, those work. I mean, that's
I've seen them work. I've seen some of the chatter, people saying like that they don't work. All I see is that they do in fact work, and Marty Lipton has made a lot of money over his career by helping companies do exactly this. But to me, the biggest, the biggest poison pill in a sense would be testing Elon's true intentions here, in the sense of I would, if I were the Twitter board, I would accept the offer. With a breakup fee, like a significant breakup fee.
Yeah.
I want a $5 billion breakup fee. Like, we agree. It's a $5 billion breakup fee, though. If you can't close this, you write us. By the way, like, breakup fees are standard. Yep. They're like perfectly standard. It's nothing vindictive or anything. It's just like $5 billion breakup fee. If you can't close this transaction, you send us a check for $5 billion, which is more profit than Twitter has made combined over the last 5 years. So more to 8, 6, 7 years, whatever, right? They actually don't make that much money, especially not recently. So yeah, but I would say, look, if you're serious, you should be perfectly comfortable with a $5 billion breakup fee, and let's go. But they're not going to do that. Well, as always with all things Musk, stay tuned. Brendan, what do we got? What are we looking at for next week on data?
Actually, a fairly quiet week. We have the market manufacturing service PMIs, the global ones from all over the place. We got some housing data in the United States. And then, as we alluded to earlier, the Chinese are going to probably cut their loan prime rate midweek. That's about it. And we have Easter Sunday, and then Easter Monday.
Looking forward to the weekend. I hope you all have a great Easter.
You too.
We'll catch you next week on the Macrocast. Thanks, guys.
Bye-bye.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.